Thank you, everybody, for joining today. We're going to cover section two of our quantitative modeling series, focusing on fundamental building blocks. My name is Wes Sapp, and I'm the global product specialist at Empirical Research Partners. Today, we're going to focus on valuation metrics and two of our management behavior super factors, focus on capital deployment and earnings quality, giving you some examples of factors that can be useful when building quantitative tools and how we've kind of evolved over time at Empirical. So the first section is going to focus on valuation metrics. So valuation metrics, you can see the pie chart that on the right here, the factors that we ultimately utilize when it comes to judging a company's valuation. And we do consider a lot of different perspectives when it comes to assessing valuation. This is going to have more of a contrarian feel when it comes to your model's construction, right? If you're buying a stock that's cheap, ultimately it's probably a little out of favor. That's what made it become cheap in the first place. When it comes to valuation, this framework, and actually all of the frameworks that we utilize, we are tailoring the metrics that we use, not just for a broad kind of US overview. We're also looking at efficacy at the individual sector level, and we're comparing the stocks versus their sector peers with maybe a little bit of a different construct depending on what is efficacious. So we don't necessarily treat a bank the same way that we treat a semiconductor stock. We don't treat a staples company the same way that we treat a stock from consumer discretionary. So we can look at about 17 different variables when it comes to valuation. We are big believers ultimately in the efficacy of cash flow metrics. You'll see that as the largest piece of the pie chart here in the upper right-hand corner, but we have some deeper value metrics that are included. We look at total yield and dividend yield. We look at some earnings metrics ultimately as well. So again, I mentioned we're big believers in the efficacy of cash flow metrics because we think they have delivered better alpha over time than something that's more traditional, like the way that, Russell defines the index, their Russell 1000 value index, and they focus a lot on book or earnings. Those things can be useful, but ultimately we see free cash flow as delivering better performance. You can see some return data here in the bottom left-hand corner of the chart. The gray bars show the performance of the highest quintile of three separate cash flow related metrics over time periods going back to 1950. Looking back over the last couple of decades since 2000, and then ultimately looking over the last 5 years. We also see the underperformance for stocks that look the most expensive, those that have the lowest yields, and you see pretty nice results over each of these different periods. One of the reasons why we think free cash flow works so well is that ultimately we think the market has chronically expressed a disbelief in the sustainability of cash flows. That's something that we've actually been tracking here at Empirical for about 2 decades now. We've talked about it in the context of the Bretton Woods 2 system, where we've seen companies have adopted a capital light model and done a lot more to ultimately predict their free cash flow production. And you can just get a sense of the efficacy of our value metric compared to the returns of the Russell 1000 value here on the chart that's in the bottom right. So basically a 2 decade look at the performance between those two indices. And you can see Russell 1000 values, kind of more traditional construct when it comes to valuation, has delivered outperformance over these last 2 decades, but you're getting multiple times more performance by focusing on what we think is a little bit more of a nuanced definition of value. So talking about free cash flow enterprise value, so you see ultimately the definition here. So we start off with gross cash flow, and then we subtract capital expenditures net of the proceeds of sales of PP&E. We make some other adjustments. There are different definitions of cash flow out there, and we found that obviously the results are going to be really correlated. So using the methodology that makes the most sense for you and your firm is perfectly fine, right? We've come to a definition that we're comfortable with over the years, and we do think it is a kind of a superior definition. We've also started to analyze a lot of our metrics relative to enterprise value instead of relative to market capitalization. And you can see that we do that here, and looking at enterprise value is just taking that market capitalization and adjusting it for some of the debt that the company has taken on. So this free cash flow enterprise value is probably the largest single valuation metric that we have in our modeling framework, and something that we've seen deliver pretty consistent alpha over time. And again, like kind kind of was hinted on the prior chart, superior results over the last decade or so when a lot of these more traditional valuation metrics have had a hard time delivering consistent performance. Those deeper value metrics kind of mention like things like price to tangible book or gross profit to enterprise value. Those can be really useful. If you back test these metrics over long periods of time, the returns can match up with probably anything else that you ultimately test. But what we found is that the returns to these types of measures maybe are a little bit more episodic in nature. And so we want to be careful in how we apply them and also when we apply them. So if we're in a period like during the pandemic, or we're in a period like during the financial crisis when we're seeing extraordinary valuation opportunities, that's a good time to lean into something like price to tangible book. And that also has the advantage compared to like a cash flow metric that if we're looking at companies going through a rough time or into a recessionary period, a lot of those cash flow metrics can flip negative. And so that will make a stock that was really cheap all of a sudden look really expensive. You don't really have that issue as much with a factor like price to tangible book. That's why we tend to use that also as a stress gauge in some of our valuation spreads that help us to time when to bet on these value metrics. And kind of a more recent valuation metric that we've kind of talked about over the last few years has been R&D stock to enterprise value. This is a metric that we've been able to apply successfully in kind of more growth-oriented environments and more growth-oriented sectors in general. For this, what we're doing is we're basically capitalizing the R&D expenditures of a company. We are using the company's sector to help us get a sense of how long we want to give them credit for their R&D expenditures. Like a pharma company that has good patent protection is going to be able to enjoy a longer look back period compared to maybe an auto, which is not going to have those same protections. And we might want to focus on a shorter term period here. So what we'll do is we'll aggregate up those R&D expenditures and turn them into an asset that we can judge these stocks against. And ultimately, we want to be able to buy this intellectual capital at a discount. And it's something that again, we've had good results for and is now a pretty important piece within our valuation framework. And so you can see R&D stock to assets in their growing importance here on the left-hand slide of the chart here. We've just seen intellectual capital become more important in general within the markets, growing from about 3% to closer to 7% over the last almost 50 years now at this point. And a lot of that has just been the shift in the markets towards more technology, more kind of interactive media type stocks, more healthcare companies within the US. And we'll show some time series valuations ultimately on the right-hand side, comparing those different groupings. So in this particular chart, this was one that was in one of our portfolio strategy pieces last year. You can see that small cap biotech is ultimately offering really expensive relative R&D stock to market cap ratios. Sorry, this is a yield, so it's actually a really cheap R&D stock to market cap yield compared to what we were seeing with tech and interactive media at that point in time. So looking for valuation, this is something that, again, we have seen it deliver pretty considerable alpha over time. And our data set does go back over 70 years now at this point. So this is looking at the returns to stocks. So in the cheapest quintile valuation, the gray bars, and the richest quintile, the most expensive quintile stocks in the black bars. There have definitely been periods of time when the value performance wasn't as strong. And a lot of that had to do in the 2010s when economic growth rates and real rates kind of plummeted, and there was a certain advantage to being a growth company over that period. But even with some weak periods tossed in there, saw positive performance in the 2010s. We're off to a good start within the 2020s, and you can see really exceptional returns in the 2000s and the 1980s and the 1970s. So we think value is something that's an important part of any kind of model construct. The weight that's assigned to it is ultimately going to vary based off of your objectives, right? If you want to manage a core portfolio, then ultimately valuation should be a considerable weight. If you have more of a kind of a growth mandate, valuation is probably going to be more complementary compared to something like a momentum signal or something like a quality signal, which we'll touch on a little bit later. But at the end of the day, the price that we pay for these securities, we do think ultimately matters. And so when knowing when to make that value bet and when to expect returns like the 2000s instead of the 2010s or the 1980s ultimately has a lot to do with factor timing and factor rotation. So what we're showing here on this slide is the weight that we apply to valuation within our modeling framework over time. So we have a target weight of right around 30%, maybe a little bit under within our US core model. But ultimately, you can see the extremes here, right? During the financial crisis, the gray bar towards the right-hand part of the chart, the weight that we applied to valuation at that moment in time was about 65%. During the pandemic, if we look a little bit further on the right, the weight on valuation at that point was about 50+%. So when the odds are stacked in our favor because valuation is on sale, right? There's really large dispersion amongst value stocks compared to the rest of the market, or in our regime indicator that looks to forecast the stylistic bias of the market, we see attractiveness within the value space. We ultimately want to be able to take advantage of that, and because that's the situation where we are getting really exceptional returns. Maybe not over the next week, maybe not over the next month, but getting really exceptional returns to valuation over the next year, over the next 2 years. There are alternatively other periods of time where we just don't think the odds are stacked in our favor when it comes to valuation. So if we look at kind of the BRICS boom period around 2006, 2007, the value opportunities were really narrow in the markets. And so ultimately we wanted to look for a better opportunity elsewhere. Same thing was true in kind of the 2017, 2018 trade war period. And also looking back kind of in the period of the bond stability trade. So we want to be flexible in how we apply valuation in particular within our modeling framework, just knowing ultimately there's going to be periods of time when the benefits for betting on value are going to be larger than others. All right, so looking at the second set of factors here, capital deployment is really going to be the first of two management behavior super factors that we talk about today. Capital deployment is going to be a little bit more contrarian in its nature compared to earnings quality, which we'll wrap up with. But we can see the construct that we use for capital deployment here on the right-hand part of the current slide. So the reason why I talk about it being a little contrarian in nature is we do focus a lot on a company's capital spending decisions. And our view is that ultimately companies that are doing more with less tend to outperform. So we utilize metrics like capital spending growth or capital spending versus trend. We'll look at capital spending to depreciation. What we found in general are those companies that are tightening their belts, they tend to outperform, right? Think about, the energy sector. Is the best time to invest when everybody is bringing new capacity online? We found the answer to that is no. Ultimately, you want to figure out the time when people are starting to tighten their belts because that helps them to generate additional free cash flow. That's what we want to key in on. We also look at changes in inventories. We have an M&A factor here that looks at the likelihood of success or failure of any merger or acquisition of sufficient enough size. And we do have a suite of factors that focus on the return of capital to shareholders. This is something that we view as a positive, right? If a company is buying back shares, that tends to positively impact the stock's share price performance. Same thing is true with dividend growth. And we also look at some different combinations of those two metrics together. The reason why we want to kind of look at capital intensity in a bit of a contrarian way is that we think we're looking at the guardianship of the company's capital when it comes to CapEx, right? If a company is really burning through CapEx and they're bringing down their cash balances, that's something that we think ultimately impedes long-term price performance. We think ultimately that the managements and in certain sectors, they actually do create the cycles, like I mentioned with energy. We see that with the materials companies as well. So focusing on companies that are being good stewards of the capital they have at their disposal is something that is very much a worthwhile endeavor and something that we found really good benefit when it comes to alpha generation within our models. So looking at how those resources are deployed, talked about capital expenditures, we talked about inventories, we talked about the return of capital to those shareholders. We've also looked at different things when it comes to capital deployment in the past, looking at things like book leverage, looking at the issuance of convertible securities, looking at the change in shares outstanding. So looking for a company that's just efficient in their allocation of capital is what we're trying to identify here in a systematic way. So I mentioned before, high levels of capital spending relative to depreciation or past norms is generally a bad sign, right? We don't want to invest in the companies, at least from a capital deployment perspective, when you see a management that has a great new idea, right? We're trying to avoid those stocks where they're spending 30% more CapEx than they did last year, and everybody else in the sector is at 5%. That's more of a great sign of the management overconfidence or management's getting in over their skis compared to that company that is just kind of consistent when it comes to their capital expenditures. That M&A factor that I mentioned before, looking at large numbers, ultimately acquisitions have been destructive to performance across the markets. We try to be a little bit more nuanced when it comes to judging those mergers and acquisitions. And we look at things like the terms of the deal. We look at the history of the acquiring firm when it comes to making a judgment. This is a factor, again, just because more acquisitions are value destroying than value accretive. It's a useful kind of more signal of a stock underperforming. If we see a stock that has an acquisition coming down the pipe and they have a negative characteristic, that's something that we want to avoid, or if we have the ability to ultimately short the stock. And then looking at the shares outstanding, I talked about the benefits of that, right? Increasing your share buybacks or increasing your dividends. That's really seen as a positive sign, but we are looking to avoid the negative as well. Obviously, cutting a dividend has been something that historically has been a really bad sign about the company's health. We've also looked at companies that are diluting their share base. And if we see really big share dilution, whether that's to fund an acquisition or fund increased capital expenditures, that has led to underperformance historically. And then utilizing capital deployment, we think it complements valuation really well. We've talked about capital deployment as being one of the signals that we want to look for in trying to avoid value traps. So if you see a stock that looks cheap, it could be cheap for a reason, right? It could be a really poorly run company, or there could be some kind of permanent impairment that we might not see in other places. But if the company has good capital deployment scores, we can at least trust that the managements are doing what we feel like are positive things when it comes to a stock's recovery and ultimately revaluation, right? If they're paring back capital spending, if they're paring back some of the wasted expenditures, they're becoming more efficient when it comes to their inventories. Those are all things that we think can help to catalyze values performance within a particular stock. All right, so looking at the last of the factors that we'll review today, that's earnings quality. So earnings quality is really the other half of the management behavior coin. Capital deployment is probably more contrarian in nature. Earnings quality is a little bit more growthy, a little bit more momentum oriented. So this is where we're looking for companies that are running great businesses. And sometimes we'll get pushback from companies when our investors, when it comes to our capital deployment signal, and say, well, my company is a really great allocator of capital, and you're going to penalize them on capital deployment. And that answer might be true, but what we're ultimately going to capture is signs that they are a good allocator of capital, and we're going to reward them within our earnings quality framework. So earnings quality has been a really important component of our stock selection framework for the 3 decades that we've ultimately been modeling stocks. But as we've seen increase in kind of the tech space and the healthcare space, the efficacy of earnings quality has ultimately increased. You see really great returns in the 90s and the 2000s, and kind of where valuation might have struggled a little bit more in the 2010s. We do see quality still performing quite well. So earnings quality is probably amongst our variables where there's probably a little less agreement on the definition, right? People, they might not agree on the specific valuation metric that we're focusing on, but they tend to understand what a cheap stock is versus what an expensive stock is. For our client base, at least, earnings quality is something that means a lot of different things to different people, right? So return on invested capital might be the primary source of a quality measure for some clients. For us, we talk a lot about free cash flow margin. Other clients might focus on quality as just the consistency of their earnings growth rate. So ultimately, for us, that it tends to define policies related to revenue recognition, expenses, looking at kind of more accounting measures, but we've also kind of migrated more towards focusing on free cash flow. And you'll see that as we look at the construct of our earnings quality super factors. So this is on the right-hand side, the combinations that we use to judge a stock's quality. And the big blue portion of the pie chart on the upper right-hand side here, is just looking at free cash flow margin levels in some way, shape, or form. So free cash flow margins are very much the anchor variable for us when it comes to judging a company's quality. We look at free cash flow margins on their own, and then we also look at free cash flow margins with various interaction variables. So things that are providing context on how that free cash flow margin is ultimately being created, right? So if we see a stock that has high free cash flow margins and they have really good stability when it comes to those free cash flow margins, that gives us a better feeling that that company is going to be able to continue the production of free cash flow into the future. It's not just like a one-off anomalous number that bubbles up. This is something that is going to have some shelf life to it. We also look at things like R&D spending margins as complementary variables to free cash flow margins. That gives us a really good sign that this is a company that is in a great business today. That's why they have higher margins. And they're also investing in the future. They're investing in intellectual capital. And that gives us reassurance that ultimately these free cash flow margins are likely to kind of stay the same or maybe rise in the future. And this is also one of the spaces where we started to use some more AI derived factors. And we've incorporated some chat GPT metrics within our model. And with free cash flow margins, we're looking for signs of competitive advantage. And so ultimately, if we see a stock that has good free cash flow margins and in their earnings call transcripts, they're talking about an ability to raise their product prices or kind of other signs that they're expanding their market share, that's something that is a great signal for us that this free cash flow margin advantage is going to be recognized in the markets. We also look at incremental free cash flow margins, so looking for that companies that's squeezing an extra dollar of free cash flow production out of their sales. That's a positive signal. And we also do look at forecasted free cash flow growth. Primarily when we're talking about these metrics, whether it's valuation, capital deployment, or even earnings quality, we're usually relying on historical data. We have found that for historical free cash flow growth rates, those signals tend to be really noisy. So instead here, we're focusing on forecasted values. We do include ROIC here in our US model. Outside of the US, we might rely a little bit more on return on assets. We have a disclosure model, which I'll talk about in a little bit here. We look at accruals. We look at stability, which is kind of alluding to that earnings growth data that I mentioned before, having really consistent earnings growth or really low ROIC variability. We look at some balance sheet stuff when it comes to cash balances, top line growth. Heck, we even look at the number of patents that have been granted to a firm over the last 3 years as we try to emphasize intellectual capital within our modeling framework. And so we're talking about free cash flow margins. This is one of the things that we think has ultimately made margins really important as a quality measure over time. And we talked about the 2-decade advantage where we've seen the Bretton Woods 2 era kind of play out here, particularly in the U.S. markets. But we've seen rising margins across the U.S. over the last roughly 70 years. So it's a situation where we think margins are ultimately a really good distinction between the winners and losers within a particular sector. And we've seen companies being really aggressive in protecting their free cash flow margins when it comes to a downturn, right? So if we saw a time series chart, you can see a little bit here kind of around the financial crisis, we're going into really rough periods from an economic cycle. We're not seeing a lot of dip when it comes to free cash flow margins. So it's not just stuff that's important to us when it comes to building a quantitative framework. We also see it's important to companies to protect these margins because it's something that they're judging themselves on. So looking at the profitability metrics, I've mentioned a couple of these already. We utilize return on invested capital within our modeling framework in the US. We utilize return on assets typically in our models outside of the US. You can see the definition that we have here for return on invested capital, but looking at earnings divided by a company's average book value and long-term debt. You can also get creative, I think, with the calculation for return on invested capital. Again, this is something that people will look at different inputs here. Same thing can ultimately be true with return on assets or return on equity. There is some ways of looking at these metrics, whether it's an incremental metric, whether it's looking at it versus trend. These are quality factors that we do think ultimately have a place in modeling tools, even though we do focus a little bit more on free cash flow production. And then I did kind of mention the 10K, 10Q model briefly, and this is something that we built that looks at kind of more non-traditional data sources. So we will look at a company's quarterly or annual filings with data that's provided by Edgar and look for companies where there are massive changes. So what we found with this 10K, 10Q disclosure model factor is that if a company is basically cutting and pasting these filings, that's a company that's much more likely to outperform. If there are wholesale changes where they're trying to explain away something that occurred, whether that's a merger, or they're trying to explain away a lawsuit, or they're trying to explain away event like California wildfire that's caused by a utility, those types of things end up falling in the disclosures, and those changes are usually pretty negative signals when it comes to a stock's share price performance. So when we look at earnings quality or even capital deployment, not all of the data ultimately needs to come from a company's balance sheet or a company's cash flow statements. We can ultimately use some non-traditional sources here, not just looking at earnings or not just looking at free cash flow. There are ways of ultimately squeezing out additional alpha using some of this data in a little bit of a different way. So that's our presentation today on the fundamental factors that we utilize here at Empirical from a quantitative modeling perspective, looking at valuation, capital deployment, and earnings quality. We will set up the next section that is more focused on technical metrics for a section 3 presentation.